Thanks, Sam. This is Dave Dickinson. First off, let me talk about what we're going to talk about today. As Sam said, this is a two-part webinar. There was 2 hours presented on July 12th and then another 2 hours today. And what we will cover today is in that table of contents. Hopefully you've had a chance to print out the materials for this packet. Altogether, it's about 48 pages. Now, it's really 37 pages of things we're going to go through today. And then there's another 11 pages or 12 pages of Q&As from a previously offered webinar that we had that we feel like would be beneficial, so we included those in there as well. If you look at the table of contents, you're going to see that we're going to talk a lot about how much flood insurance to have, and under various scenarios like multiple buildings and low-value buildings and detached garages, construction loans, and all those types of things. A lot of today will be in that Roman numeral 1L condominiums. Jerod's going to talk about the residential condominiums and commercial condominiums, and because that's a pretty complicated topic, I let him talk about that one. But we will talk about forced placement and then monitoring, escrowing, letters of map changes, and things that you need to know to really be the gatekeeper in your bank to make sure that you've got the right amounts. So things that we won't cover that were covered in Part 1 had to do with the new Reform Act that came out July 6th, and we briefly talked about that. We're actually planning a future webinar because it hasn't really been officially released yet as a regulation in the Federal Register. When that comes out, we'll dissect it and we'll pass that on to a future webinar. But in Part 1, we talked about that was out. We got into a lot of the overview, big picture requirements, and then we got into flood determination forms, the notice, and a bulk of last time, about 30 minutes, was spent on this topic called insurable value. Now, why am I telling you that? Because this is 4 hours of training. We don't have time to duplicate that information. And so if there was a lot of questions, and I know there's a lot of you that are attending both sides of this, all 4 hours. So if you asked a question during Part 1 that had to do with what we're going to cover today, we're going to try to cover that today and answer those questions. If you asked a question today that was materials that we presented in the first part a week ago, we won't answer those today because we just don't have time to go back to materials of information. We want to stick to what we're presenting today. So that's what we're going to cover, what we won't cover, and there's a link so that in case you aren't someone that signed up for both, you can still go back and get that information. Let's go to page 1 of your packet, and I also want to let you know that anytime you see anything in italices, we're actually quoting from the regulation or the mandatory purchase flood insurance guidelines or the FAQs that came out in October of 2012, and we'll try to give you the source. So if you look at page 1, Roman number 1, you'll see there that this is a little bit of overlap because this is where we left off last time. How much flood insurance do we have to have? You have to have before you close the loan, not fund it, but before you consummate the loan. And the borrowers sign on the dotted line, that I'm legally bound. Before you close the loan, you have to have what we call the lesser of 3, and the lesser of 3 are listed there in A1. So lesser of 3, it's my principal balance of this loan and any loans in front of me, all loans secured by that property. It's the insurable value, and again, we spent about 30 minutes on that, so we won't be able to go through that again, or the maximum available, and the maximum available is listed in a table there on the bottom, page 1, depending on if they're an emergency program or regular program, depending on if it's a dwelling or non-residential structure. And then there's content coverage, and we're going to talk about that today as well. So we'll put it together and say, let's say that you have a commercial or non-residential building and contents and how much flood insurance. And we're going to give you lots of mathematical examples. So there's a lot of pages here, but some of them we're going to move very quickly through because they're just mathematical examples that take up a lot of space in the outline, if you will, but maybe not so much time. So Jerod, why don't you get us started on page 2 of talking about deductibles?
Yeah, deductibles is the first thing we're going to talk about today when it comes to required amounts and how much and things that we have to deal with when trying to determine exactly how much insurance to put in place and then how we kind of go about that. Really, there's 2 rules that we want to make sure that we follow when we're dealing with deductibles. And the first one you'll see at the top of page 2, you can't ever allow the borrower to have a deductible that's equal to, and then you might want to write in, or more than the insurable value of the property that we're dealing with. Why is that? Because if I have a deductible that is higher than or equal to the lesser of, you're going, wait a minute, what am I insuring? I get no insurance. So let's say we have a $4,000 loan. You can't have a $5,000 deductible. You'll have to have it less than the loan amount if that's our lesser of that we're dealing with. So we can't have our deductible set up in order to avoid the flood insurance requirements. You'll see underneath the deductibles there, number one, there's a minimum, there's a maximum. It really depends on when your property was built, when the map was set up. Really, that's the insurance industry side of it, not the mandatory compliance side. But you need to know enough about those that, it's 1,000 or 2,000 as far as minimums go, and talk to the agent about that.
And, Joe, let me interrupt just a minute. There's an acronym there we probably should define. In letter A and B, it mentions this FIRM. FIRM is the Flood Insurance Rate Map. So really what it's saying is, when was this residence or non-residence built? Prior to the map coming out, or after the map came out? And I don't know why that matters, but that's what the National Flood Insurance Program says.
Yeah, they don't let us make the rules.
Yeah.
So that's really the first thing we need to deal with when it comes to deductibles. The second one, and this really comes from one of the Q&As, it's when we're dealing with these minimums and maximums. What it says, it's not a safe and sound business practice to just let everybody max out the deductibles. Obviously, the higher our deductible, the lower our insurance rate, or the lower the cost for that flood insurance. But the reason they bring this up is not everybody can withstand the same deductible in the event of a loss. What they'd like us to do is to underwrite each person and say, okay, Dave qualifies for this much deductible. Jerod, he doesn't qualify for as good a deductible. Maybe I don't have the wherewithal to withstand something in the event of a loss. So let's say it's a non-residential structure. You can go all the way up to $50,000 on that for your minimum deductible. If I can only afford maybe $4,000 or $5,000, that's all you should let me have. And maybe Dave can afford a $50,000 deductible. Each person should be different. We shouldn't just say whatever you want and let people max out, because it's not a safe and sound business practice. We're going to go through some examples here, but I wrote a couple extra notes off in the side margin here, and I think you've got some room on your page too. And I'm going to ask Dave to jump in here in a second. A couple years ago, if you happen to listen to this webinar, I was pretty hard and fast about that you need to look at your hazard insurance, and whatever deductible you have there, your flood insurance should match up to that. And well, there's no reason those things shouldn't be different. And actually, Dave, you kind of helped me understand that, there could be a difference there.
My
assets, and I think you've got a pretty good example even.
Right. My arguments are, I have hazard insurance on my house so that if somebody drives a golf ball through a window, or my daughter backs a car through the garage door, just as an example, like that's ever happened, or hail, wind. I mean, there's lots of perils, if you will, that hazard insurance is trying to help us insure against, whereas flooding is just about floods. I mean, that's the only reason. And so there's an argument that if somebody drives a golf ball through my window, I should probably maybe think about having a lower deductible, because I can make claims then, whereas flooding typically is going to do more damage. That's one. But as Jerod is trying to bring out, too, is the liquidity of the borrower and their assets and other types of things that they might have needs to be considered. So I can make some arguments that it's not just the same as the hazard insurance, whereas liquidity, assets, those kind of things probably would justify they both be the same.
Absolutely. Thanks for sharing that. The examples on the bottom of the page, what we're going to do is just go through it. There's a residential dwelling there. We've got a $5,000 loan amount. The property that's securing this loan that's in a special flood hazard area has got an insurable value of $25,000. Because the lesser of in this case is going to be $5,000, the max deductible that we can have on this is $4,000. And why do you say $4,000? Because it's sold in $1,000 increments. So the highest possible would be $4,000 in that example. Letter B, the non-residential, $30,000 loan. The value of the improvements securing the loan that are in the special flood hazard area in this example is going to be $50,000. Obviously, $29,000 is then going to be the highest deductible that we can have in this scenario. And again, $1,000 increments is how we come up with that. So keep an eye on those deductibles. Make sure you have a process in place or procedures that outline how you're going to deal with deductibles in your institution.
And I would just add, and make sure you document when somebody's getting a $29,000 deductible why you feel like that's justifiable.
Yeah, absolutely. Documentation goes a long way on this stuff. Page number 3, if we can next, letter C at the top, multiple buildings, very hot topic. And people are starting to get around to this. I think a lot of the banks that we deal with, that we go into, are doing a much better job on this, but there's still a few out there, and some people that don't quite understand how it's supposed to be set up. When it comes to the flood insurance rules, all buildings that are secured, that are securing the loan, all improvements that are in the special flood hazard area, have to be covered to some degree by flood insurance. We don't care how much necessarily is allocated to each building that's in a special flood hazard area and securing the loan, but there has to be some on each, and when we add up all the amounts, we got to equal the lesser of calculation that we spent so much time on in the flood webinar 1 and then Dave.